Well, good morning. Good morning. Well. Man, I gotta tell you, I gotta get this part out of the way first because I know some of you guys get your feelings hurt when I when I sprinkle it through the sessions. If it's a live stream, obviously it's unfiltered. I'm gonna say words that probably aren't gonna be good for children. You shouldn't be watching live streams around your children with their sensitive ears, especially knowing how I am. I might be using some sentence enhancers every now and then, especially when I'm trying to get a point across. But the comment section, obviously, you guys are able to leave a comment, and for the most part, it's kind of like a sugar high. It's almost like a diabetic coma. It's love fest. It's just really awesome. I get to see it, being a part of it live, and you're teaching it for free, and that's wonderful. That's great. Okay. What do I use it for? Because I'll see comments that are asking sincerely, could you touch a little bit more on the topic of this particular concept or this particular idea that you've expressed, or maybe a portion of a lecture like we've done the last 2 days. The interest, the sincere interest in understanding a specific dynamic or an idea around a PD array, or when would you not consider a specific PD array in this circumstance or that circumstance, or if the economic calendar had this or an absence of this, those are very sincere questions, and that's usually where I tuck all that type of answering and addressing those things in the long-winded discussions. And then there's other people that will leave comments like this. They'll say, I wish you would just get to the point and just tell us what we need to know. And they're usually the ones that aren't really followers of the channel, and they have like a paragraph of bullshit and just morbid curiosity. I read it because they're entertaining to me, but that's the last time you get to see their post in my, well, you can't see anybody's comments. It's for me to really see it because, like I said, majority of it, and I've already proven this. I've done videos where scrolling through the comments, you'll see a couple of them say scammer, fraud, um, uh, can't do it live, you'll never live stream, all that kind of stuff. But the majority of it is all basically like very, very appreciative, thank you, and what they've been able to make money doing this and doing that. And that's cool. But I use it really as a sounding board for getting feedback for where I may have missed in terms of discussion points. And it helps me go into a later discussion, maybe another teaching. And sometimes, it's my personal private students that are actually comment, and they'll say, at this minute marker on this particular video or in the last 2 days, they'll say, what kept you from looking at this particular candlestick in regards to what you're expecting? But there's comments that you get to make one time to me, okay? And then I just mute you. You can't be seen by me. You won't be seen on the channel. And basically you're an asshat. An asshat is a clown that literally cannot see the obvious. I'll give you a case in point. I mentioned this yesterday. I cannot, okay, I am not capable of fixing stupidity. Okay, stupidity is rampant right now. Okay, it's been engineered by social media. They've cultivated this short attention span of a gnat, and the fine art of completely understanding and learning something and applying your full attention to it is alien to these new generations. They're just completely oblivious to it. And I don't give a fuck if that offends you if you're one of them. Because if you're here to learn, I'm literally giving you my time to do it. But if something's not happening in between the last candle and the candle that's happening to be forming right now, and I have an opportunity to pull something in as just a conversation piece, That's my right to do that. I can do that. You filter it out. Okay. I'm not going to filter shit. Okay. You're either going to be here because you want to be here or you don't want to be here. Either way, I don't care. But I'm talking to the audience that wants to learn how to do this. So when individuals say, can you get to the point and stop talking about, politics and talking about your personal stories? That's experience. That's how I learned to respect the risks that are elevated right now. But you don't know that because you want to have a one, two, three, give me this and real quick so I can go on social media and look smart in front of people. And that is, like I said, it doesn't work like that. Trading is too complex. And while we can do all kinds of things to simplify our focus on what we're looking for and streamline just one or two approaches and get really dialed in with just doing that and trying to avoid every other possible way of trading so that way it's not diluting your attention. I'm trying to show you and teach you what my problems were when I was coming up, how to avoid going through that same kind of stuff. Even if I tell you in one paragraph, one simple paragraph of trading, okay? This is what you do when you want to be a buyer. This is what you want to do when you're a seller. You're still going to fuck it up because you do not know all the other things that's going to be an impact because you're oblivious. You're running forward full steam ahead thinking that you can't lose or it won't lose or you're going to be the exception to the rule. And I'm telling you, that's not going to happen for you. And you don't want to listen to good sound logic. So when I see individuals leave comments like that, and it was like 4 or 5 of them yesterday, or not all yesterday, some of them were this morning before I came on, but I was going through them, and it's just like the level of stupidity to try to say, okay, tell me what to do, but don't tell me why I should worry about this or not worry about that. Just give me the actionable points, but don't give me any of the logic behind why it could be trusted. Don't talk about the things that's going to come up in my mind because I'm a human being and it's going to be like it is for everyone else. As soon as you put a live trade on, folks, a wonderful thing happens. Your asshole starts to pucker every fluctuation that moves against you. You may not have a hard stop in that trade. And it's going to start going towards a threshold in terms of money that you don't want to see coming out of your account. And then you're going to be wishing you had put a stop loss on because now you don't know how far it's going to retrace. And you completely abandon the entire plan of what you were trying to trade. And if you were wrong, you were going to be willing to take a loss at this reasonable level. But you don't want to hear those things. Just tell me how to find the right order blocks. Get the fuck out of here. Seriously, get out of here. You're unteachable. You literally are communicating in the plainest, simplest terms that you are not prepared to learn. And you're not here to learn. You want something to go in and run off and write in an Amazon fucking book for $5 on Kindle. Get the fuck out of here. Get out of here. So anyway, the other one was a response to me sharing the dollar index chart. Um, Before I get into it, my own personal private students do this sometimes too. They like to mother me or be my father and say, you spend too much time addressing the negativity. No, actually, I'm having a sport of it because it allows me to give it right back to them and remind them that they're a fucking idiot. The chart and the discussion about sell side, okay, never came up in the dollar index. Go back and watch the first part and the second part. I told you it's very plain. It was not ambiguous. I said, this is the higher time frame, monthly. This is the weekly. This is the daily. It is finding support at that weekly consequent encroachment. It may drop a little bit. It did that day. Did it leave that daily fair value gap? Did it break below it and close below it? No. We wanted to see it go higher. That focus was allowing you to, as Forex traders, to use that in conjunction with the euro dollar and the pound dollar. So if the dollar's going to go higher, You want to be focusing on what for euro and cable? Shorts. So you want to study price action and see what forms in price to allow, or do a case study. How does the euro and the cable respond to the bullish PD arrays in dollar? And yesterday I watched with you live how it dropped down to the high of its daily fair value gap. At that moment, that's when euro was trading up into its sell side imbalance, buy side inefficiency, but leaving some of it open, exactly what I was teaching you. And then later in the day, I gave you another entry technique where we use balanced price ranges. And I even gave you the idea of looking at a classic chart pattern, which is a island reversal. That is not a balanced price range, but I use it as a way of, for folks like myself who have been trading for a long time, these old classic chart patterns. When we had, open outcry markets, there was always gaps from where we stopped trading the previous day and where we started trading the new day. We don't have that so much anymore. Now we do have new day opening gaps, which is between the difference of 5 p.m.'s close, and they do that 1 hour intermission and they start back up at 6 o'clock. So that's a new day opening gap. That's why that's important now. Before we went to electronic trading, it was every single day you're going to use that opening gap. And chances are that it probably was going to be an opening gap. It may have gapped higher than the previous entire range of the previous day's high and low, or it may gap lower at an opening below the previous day's high and low. And that gap is always going to be referred to in the same way that I used yesterday in the NASDAQ. And we're going to talk about I'm going to go through all the things I wanted you to take away. So that way, for the ones that don't take notes, I'm going to help you. Okay. We're going to take the short bus today, and I'm going to literally hold you by your hand and tell you exactly what you should have gleaned from everything. And then we'll give you some ideas about what might happen later in the afternoon during FOMC, when I won't be with you, but I'll be watching my favorite live streamers and hearing what they think and what their chat window audience is suggesting may happen. And I'll be fading that. So when we look at the dollar index, and that dollar index is likely to go higher, I did not mention anything about sell side with the dollar index. It never ever came up. It never came up. It wasn't labeled in the charts. Okay. We were looking for price to go higher in dollar. So that is what? It's a risk off scenario. Go back to day one. I stated, when you're dealing with framing a daily bias, the first thing you need to look at is how the economic calendar is going to impact the ranges on the day. Is it going to be a landmine field of high impact and medium impact news drivers? That's what we had this week. That's exactly what I told you was going to be the reasons why we can't stick to a daily bias. So that was the whole long drawn out explanation as to why do not try to hold yourself to holding a daily bias. Abandon that and just simply trade intraday volatility. That means a session bias. Whatever you think may be the next draw on liquidity for the morning session, whatever you think the next draw on liquidity is going to be during the lunch hour macro, whatever you think the next draw on liquidity is going to be for the PM session, whatever you think the draw on liquidity is going to be in the last hour of trading. How many opportunities do you need? You just need one. And if the time you're looking at it, as I just mentioned, it's specific segments of the day or London, if it's not clear to you, you don't do anything. You just sit on your hands. And then I go through the process of explaining how it's important for you to not feel rushed. But you're putting your fingers in your, not all of you, but the ones that I'm talking to. I still care, even though you're a dumbass, okay? You're literally the very people I want to help. Because I was stubborn like that in the beginning. I wanted to blame everything when it was me. And when I finally pulled my fingers out of my ears and just started listening to what my own results were telling me, these were the opportunities I needed to address. You don't want to go 3 decades, okay, and not see the validity and the value of the things I've literally given in the beginning for free. But because they're long-winded and it's boring to you because you think it's all about making money right now, when the majority of what you're trying to learn is how to keep from losing money and feel comfortable not taking action, even if the market does move around. Those are very hard things to grasp and learn as a trader, because the number one reason people get into this is they gamble. It's exciting. You might win a lot of money. And for some of you that are, in the S&M, you maybe sometimes like to get punished and spanked and lose a little bit. It gives you a thrill on it. I don't like to have that kind of thing happen to me, so I like to be very diligent about how I teach. I want you to have a very sober mindset going in. I want you to understand the risks. I don't sugarcoat shit around here. I don't do that. And unfortunately, that doesn't tickle your ass with a feather. It makes you feel like I got to get to the point. Like right now, some of you want to turn the video off. Good. Go do something else. Go watch other people wreck their ass today on live streams. Go do it. Go do it and learn nothing from it. If someone takes the time to write a comment or send me a message in TradingView and they say something that I did not do or state, and then stand on their high ground thinking that they are superior on that talking point, and they're absolutely wrong because I didn't say those things. It's not even in the live streams. Go back. I don't edit them. I don't delete them. I'm not afraid or ashamed of anything I said in them. What I said, I said. What I said, I stand by. The beginning of the week, I stated with a gun to my head, I got to say what I think my bias would be for Monday, Tuesday, and Wednesday. And the tradable market I would be interested in was NASDAQ. I stated that I wanted to see NASDAQ trade higher into a fair value gap between Monday's trading and Wednesday. And I said it might reach up in there during FOMC. And if it does, that's something I'm just going to miss because I'm not going to trade ahead of FOMC. But because of the nature of the calendar that we are in, I'm not holding myself to a daily bias. I'm not saying I have to be right about the daily bias. I don't need to be, because the volatility is going to be there so we can look for, like we outlined yesterday, even in all the mess and the muddiness of price action, right when everything started to do what it needed to do in terms of delivering price to that sell side, that's when you heard it. I outlined it right then and there and told you exactly how the market should behave. But prior to that, go back and listen. You're in no man's land. There's nothing to do yet. There's nothing to do. Nothing. But you're not listening to that. Those of you that want to get right to the point. The point is you're going to be watching charts like this. As long as you're trying to be a trader, or as long as you're going to trade the markets, you're going to be looking at these fucking candlesticks form. And sometimes they're going to be like paint drying or grass growing. And it's boring as hell. And there's nothing to do. You simply have to wait. And you go watch other live streamers. Watch their chat window. It's a bunch of fucking children. It's like romper room in there. They're not watching the chart. They're watching to see what somebody else says, and I want to pay attention to that. They're like playing in traffic. It's a matter of time they're going to get ran over. I'm not running a romper room. Do you see a chat window here? No. Because what I'm talking about is salient to the price action and the conditions around that particular time of day, that trading day, that week, that month, that seasonal tendency. All of it has something to do with why I'm even spending time with you. You're going to learn better in the harder conditions. You don't really learn anything well in the initial stages of your learning when it's the easy salad days where the market says, this is obvious. It's obvious. You need to recognize the days that you get your ass handed to you. Because if you don't recognize what that looks like in advance by the economic calendar, you're going to get wrecked. You're going to blow your account. You're going to lose. And if you're a live streamer, you'll delete your shit to try to save face. And people won't let you hide that. It'll be resurfaced. It'll be retweeted. It'll be relinked. It'll re-upload. And they'll haunt you constantly. You don't want to be someone like that. You want to be able to say, okay, I'm going to expect this in the marketplace. And if it doesn't deliver, it's okay. It's even more so better that if you don't take a trade and you avoided that, that's a skill set. You can't find that in books. I have lots of books and it never addressed that shit. The things I talk about, they're the very things that every other major writer and author and trading educator never touches on. And it's the ones that listen to those types of stories are the ones that do very, very well. In my fold of my students, and I have lots and lots of students, some of them are very private and they do fucking mad money, crazy fucking town money. And the other ones that want to be out in public eye, you see what they do. They bring their receipts. And I have lots of new people coming in. But the constant delivery of you're going to work your ass off, that remains true, constant. I never make it sound like it's going to be easier for you because that's not the reality. But it pisses me off when I see these individuals think that they're standing on some pseudo moral high ground saying, yeah, but you said buy side and sell side, one of them's going to get hit. You dumb shit. Nobody said anything. There was never even, it wasn't even typed out nowhere in fucking the dollar index. The chart was the dollar index. It was going to go up. It reacted off of the daily fair value gap. It's risk off. So if risk off is in play, that means dollars going higher. That means your euro dollar is going to drop. That means your pound dollar is going to drop. That means NASDAQ's going to drop. That means S&P is going to drop. That means Dow's going to drop. That means Bitcoin's going to shit the bed, and it shit the bed too. So how do you want to find the big moves? Do you want to go on the internet and play Nostradamus? Or do you want to be someone that's going to go through the details, put your hands in the mud, get dirty with it, watch hard days like this, watch hard weeks like this, and feel what it feels like internally, emotionally, psychologically? Are you wrestling with the desire to want to do something right now? Because if you feel that, you need to address it and dial it the fuck back. You got to tone that shit down because that's exactly the very first step to you blowing your account. That's the first step, that heightened state of, I need to do something right now, real quick. I'm missing out. Other people are doing this and doing that. You already highlighted all of your problem points. You're impatient. You don't have a plan of action. You don't know what you're doing, and you're worried about everybody else and what they're trying to do. You have a grocery cart of shit that you need to put back on the shelf. None of that stuff needs to go on any further. No more looking for entry patterns until you address that stuff. Because that stuff is going to plague you. No matter if it's me teaching you or somebody else, that stuff is going to resurface. But you don't want to hear it. You talk too much about other shit. Get to the point. Listen to me. If you have that mindset, I really, really need you to listen. And I mean this sincerely. Go fuck yourself. And if that offends you, please unsubscribe. Don't ever watch my shit again. Because you're literally a fucking idiot. You're an idiot. You're doing everything wrong and you're going to fault everyone else for it. And I'm just not going to give you a stage for that. I'm not going to do it. I have too many people out there listening and doing it the right way, and you ignore that. I sit in here and I tell you what the market's likely to do, why it shouldn't be a big factor right now, why you shouldn't be in a rush to do something, because these are all skills that you're going to have in your repertoire when there's nobody sitting with you. When you're trying to do this all by yourself, you have to have these skill sets to tap into. This is how I was trained. This is what I'm supposed to focus on. This is what I'm supposed to not worry about. And these are the things I need to worry about. I need to worry about trying to move fast when I'm trying to make money. When you feel that little itch, yeah, I was going to trade one contract, but fuck it. It feels really bullish. I'm going to go with 5. That's a rule being broken. You're increasing risk on an impulse. Never, ever, ever do that shit. That's worse than adding to a loser. You haven't even gotten into the market yet. And when you change your whole initial step, or when you're placing your foot in the water, you're like, if it's cold or if it's shallow or if it's got something sharp beneath the surface, I don't see it. I'll find out once I jump in. And that's exactly what you'll repeat over and over and over again in the beginning, because you don't have any self-control. And because you don't have self-control, you're not going to have any personal responsibility. So it's going to be easy for you to say, well, I tried that ICT shit. It doesn't work. Okay. Explain how everybody else that's making money with it is making it work. They're more disciplined. They have personal self-responsibility. They've gone through the hard lessons that you are thinking you're going to tap dance around it. You're not going to be the exception. You're not. Okay. So I had to get that out of the way for those that had to endure it. Thank you. But we're going to look at some of the things I mentioned this week in regards to, we'll first start with dollar because that's how we started this whole carnival this week. I hope you're doing well. I slept like a baby last night. I actually didn't want to get out of bed. It was really comfortable. So we're looking at a 15-minute time frame. Let's look at the daily real quick. Today is FOMC, as a reminder. They're going to give a rate announcement later on. I'll probably repeat this again before I close with you, but for now, while your attention span's a little bit higher, hopefully. FOMC generally is a two-stage event. What that means is whatever you see happen going into the 2 o'clock hour and delivered to going into 2:30, that's usually the fake move. So not all the time. Very, very rare. There are instances where the first move at 2 o'clock is just the first leg of the move. And then there's a small little retracement between 2:20 and 2:35. And then it continues and keeps going in the same initial move. But that is so infrequent. It's so not likely that I always look for FOMC to behave many times like non-farm payroll. So this is also what you can do when you study Friday when I won't be with you live, 8:30 Eastern time. Non-farm payroll usually is a two-stage event too. It's usually an initial move, but it's a shortened time. It's like really sudden. It's an initial move and then boom, does something the other direction. So they push people in one direction or knock people out of the trade that would be profitable later. And then they smoke everybody and take them the other direction aggressively. That's a classic non-farm payroll event. It's always been that way since I was looking at the markets in 1992. And for the most part, it still largely does the same type of stuff. Not every single time, but more times than not, it's how it usually behaves. But FOMC is a two-stage event. That means there's going to be a large move that usually starts going into 2 o'clock or initiates at 2 o'clock and completes somewhere between 2:20 and 2:35, and then it goes the other direction. Don't take my word for it today and plunge and trade. Study it, observe it, okay? And every single time we have a rate announcement or FOMC event, you study it with that in mind. It's not an inspiration or an invitation for you to go out there and try to trade with your funded account, with your live account, none of that stuff. But they're wonderful resources to tap into for experience and see how the algorithm is allowed to do what it does, or sometimes they completely go in and manually intervene. And you'll know that because when it does crazy town, one-sided, just like it's super beyond exaggerated, that's manual intervention. Algorithmically, it'll go into a 15, 30, or 60-minute pool of liquidity. That's reasonable. But if it goes beyond that, that's manual intervention. So I've answered a lot of questions right there that you may not be aware of, but the people that have asked that question now have their answer. So that's why I talk a lot, you stupid fuckers. So and for the folks that are sensitive here, I understand that it would be better if I didn't use that type of language. But sometimes I don't have control over that. And that's a frailty on my part. That's why I'm not the best mentor. That's why I'm not a good teacher, because I can't control my tongue at all times. So we're looking at the dollar index. This is that daily fair value gap. Okay, see, here's the candle's high, that candle's low. That shaded area, when we were looking at it on Monday, I said it could drop down a little bit more. It did. Did it come outside of the fair value gap? It wicked. But did it close below it? No. The focus was we want to see it try to gravitate higher. Now, this entire market structure right here could completely collapse. And we could see dollar down in here today. Why? Because this event, much like non-farm payroll, listen, it invites the potential, a greater likelihood of manual intervention. That means the algorithm is turned off and they say, this is where we want it right now. And they take it there immediately. It's a straight line, run right to it. It's untradeable. You can't participate in it. It just simply demolishes and wrecks everything. If you're in the way of it, or if you're in it and it's against you, you're getting crushed, murdered, pulverized, and decapitated. So, with those adjectives, do you want to trade it? I'm trying to be as responsible as I possibly can to highlight the level of risk that's associated with these two events, non-farm payroll and FOMC announcements. It is such a gamble. It is such an unlikelihood that you're going to be consistent about being right about it that you shouldn't do it. Simple. But it teaches a great deal about how market seeks liquidity and or inefficiency, because those two things are still in operation there. They're just going far outside the normal realm of what would be considered normal volatility to get into those inefficiencies or to tap into that buy side or sell side liquidity. I promise you, the level you're probably looking at today, it's probably going to go right through that. It's going to go right on through it, like it wasn't even, a problem for it. Like it's like a hot knife through butter. And when you're brand new in trading, you don't, number one, see that, expect it, or understand that that's usually what happens. And when you have a big event that goes outside the realm of normal volatility, it shell shocks you. And if you lose money on that type of event where you lose money at that sudden quick pace like that, and the account is blown, it's so demoralizing. Even if you had the money to put into an account, you take a little bit of time to think about, do I really want to do this again? And that's scar tissue. That's stuff that's going to plague you as a trader forever. It'll never go away. I can still remember the losing trade of orange juice on my first one, and it hurts because I wanted my first adventure in this to be profitable. And the first trade I did was a trade I didn't understand, which is what everybody does. Well, let's see what happens when I push the button. Well, you did it wrong. There you go. There's your prize. So when we're looking at the dollar index, we're looking for the market to continuously drive higher today. Now, can it do it before FOMC? Maybe. Maybe during FOMC at the 2 o'clock hour, the first move is it runs up to tap into this, and then it folds. That can happen. I can tell you these scenarios because I'm not going to trade ahead of FOMC. I will be looking to take a trade between 2:30 and 3:15. That's what I want to do today. My own personal trading, that's what I want to do. And I won't be doing it with a fucking demo account. And I won't be trading with a demo funded account. Okay? I'm going to be doing it with a real account. So it demands your attention as to what I'm going to cover today, because if I'm willing to trade on the things I'm going to cover in today's discussion, you'll understand why I'm willing to do this. And you'll also understand the things that would negate that. What happens if it does this? Then I won't take a trade. If it does this, I won't take a trade. But if it does this, this, and leaves these things in place, I will be looking to take a trade. That's logic. That's what you need as a trader. Down close candles and saying, here's the rules for order block, and here's the rules for fair value gap. All that stuff, that's just one cog, one little piece of the machine. It does nothing for you. You could have a Ferrari, and take one of the main components off the engine and hand it to somebody. Can Can they drive a Ferrari? No. They're holding an important part of that Ferrari. But the part that came off that Ferrari, the person that owns that Ferrari, they can't drive it. Why? Because it's missing something. One person holds one thing that has greater impact over the larger whole. But by itself, that one little component can't do anything. But it's essential. And the newer students that come to me, they expect immediate gratification and understanding the first time they look at something. And that's not because there's a poor teaching approach. It's complex. It's a lot of moving parts to get a clear picture about what may happen. Your indicator isn't going to help you filter all that stuff out. The only thing indicators do is give you a timing element to a decision that you're not really making. You're saying, okay, I'm looking at moving averages that are sloping down. So that means I'm bearish. Okay, you've removed personal responsibility and you've placed it in the hands of crunching numbers. I'm not going to disparage that. I made money in the 90s doing that. But you have removed the personal responsibility of determining what the market momentum is going to be because you look at moving averages. Wonderful. If it's bearish, that means the moving averages are pointing lower, and I'm using some really basic shit here in retail stuff. If you have an overbought, oversold indicator, we'll use a 9-period Williams percent R. If it goes overbought, that means now you're going to go short. I'm telling you not to trade this way, but I'm telling you that you're placing things that are outside yourself. You're not making the decision. You're letting math tell you. And numbers can be tortured, and they'll submit to anything you want them to say. You need proof? Change the settings on your indicator. Your overbought might not be so overbought when you use a larger degree in terms of the period of range that it's measuring. A 9 period is pretty quick. It's measuring about 4.5 rate of change. It's usually half of whatever the number is that you're using for the range, that multiplier. When it goes overbought, if you're an indicator person, like I was when I first started, I would go short if it was overbought and moving averages were down. I'm timing something that I don't really have an understanding about because I'm trusting the math behind it. I'm deciding the direction because I'm looking at moving averages. So it distracts me from requiring myself to make the decision about both the direction and the timing of the entry. I'm not comfortable with that. And I'm going to submit this to you that you shouldn't be comfortable with that. There are times where if you understand how I interpret price action, how I teach my students to read price action, if you want to use indicators, they're going to start working for you then. And that's the part that people don't like when I talk like that because it sounds like I'm being arrogant. But that's what I discovered. I discovered the times, the conditions, the settings when indicators were going to work. Because think about it, you can buy a book. There'll be books written 20 years from now. And they'll talk about old horse shit, retail patterns, moving average crossovers, overbought, oversold, stochastic divergence. All you need is stochastic divergence, dude. Yeah, we'll do it. Live stream it. And these people just shut up real quick. But if you apply the logic I'm teaching you, the indicators will suddenly seem like they're perfect. And what was missing in the beginning with me, and why I believe the writers of these books don't show you them trading with it, they just give you static images where it worked in the past. And the old adage is, during the gold rush, the people that were digging for gold never got rich, but the people that sold pickaxes and pans, they're the ones that got rich. And that's why education makes a lot of money, and it's fast, easy money. But most of you that are trying to learn how to do this, most of you are going to fail. Not because you weren't trained properly, not that you don't have sound logic, because there's all kinds of things out there that you can make money with. but because you won't do the right things with the information. And this culture that we have now is blame everybody but yourself. And you can't do that in trading. You can't do those types of things. So if you have those tendencies, maybe you aren't somebody that leaves comments or trolls other people and talks shit about them. Maybe you're not like that, but you feel the impulse to want to do it, but you say, you know what, I'm a better person than that, and I just don't do it. You still have an underlying problem. You need to address that because they will surface in your trading. I promise you, they will absolutely surface in your trading. And it's always going to have some direct correlation to how you either lose your account or stay in continual perpetual drawdown. You might make a little bit of money, get back to break even, and then drift lower, never making profits. Because it's the way you're thinking and the way you're attacking the process of being a trader. You're holding a lot of toxicity. And it's correctable. You can fix it, but it takes a great deal of coping skills and replacement concepts. Like you can't focus on being a dick. Like you got to say, okay, if I am trying to learn how to do this, I got to give myself permission to know and understand it's going to take me longer than I probably want it to do. And it's going to be hard. It's not going to be easy. But if I do this for a couple months, I should see progress. Progress does not equate to profitability. Does not mean consistently profitable. It just means that there is evidence to see these things are working. They may not be as frequent as you want them to be because you're still fumbling through it because your aptitude, your experience is limited. The concepts are there every single day. The daily bias may not be correct when you do the analysis. Did you lose money? If you didn't lose money, that's wonderful. That's you being wrong and still not losing money. That is a skill set. That's the first lesson you're supposed to learn as a trader. Where's the guys writing books about that shit? It's not there. And I've facetiously said in the past, I could write a book. How to learn how not to lose money. And it's probably going to be the best thing you could ever do to read it and apply it before you ever try to make money. Because these same things, I fell victim to it many times when I was 20-some year old. I repeated it over and over again, thinking I was going to beat it. Like, oh, I'll do it. I'm going to do it slightly different, but I'm going to go around that. I'll be able to avoid that. Wrong. And there's been lots of people out there that have tried to trade. And that's why I like those books Jack Swagger wrote, Market Wizards. None of them tell you how to trade. I bought them originally thinking that that's what they would talk about. But I found that what I needed to hear was how they dealt with the adversities of trading. I don't care how much money they made. I don't care their best returns. See, that's what most people, that's the Instagram perspective. The people that want to trade and learn how to do it themselves, learn how to do it so that way you ain't got to listen to me anymore. That's your motivation. Let me listen to this guy. I'm going to take everything he says and I'm going to apply it. And then once I know how to do it, I never need to fucking load this guy's ICT videos again. That's exactly what I want everybody to have. That's the mentality. I don't want you coming back to my fucking YouTube videos. I don't want you doing that. I want you to learn it correctly, know how to deal with it, how to live well in your own skin as a trader, assume the risks, own the risks yourself. Don't blame me. Don't blame somebody else. Don't blame the market. If you made money, you did something correct if you followed the rules. If you didn't follow the rules and you made money, you're a fucking clown. You just gambled. There's no difference between that and going out and buying a scratch-off ticket where there's no skill. And when you make money, wow, I'm lucky. No, you're not. That's just circumstance. You came in behind the person that didn't buy that ticket and you bought it. That's it. That's all you did. There was no skill in that. You didn't know that ticket was going to do that. So these are the very sober mindset central tenets that a trader needs to have. It's a no bullshit approach. It's no sugarcoating. It is what it is. If you make money and you did the right things, that's when you feel good about it. You don't beat your chest. You don't go out there on social media and say, I'm fucking the king of the world, but you don't let anybody shit where you live. What does that mean? You don't argue with them. You don't debate with them. Let them say what they want to say and just cut them off. Because their shit perspective, you're not going to change it no matter how much you do for them, no matter how much you make in front of them, no matter how many times you prove it to them. They're broken. There's something inside of them that's broken. And I had a lot of students come to me from other people they tried to learn from. They were broken. And I said this in paid mentorship lectures, and I'm doing it here. And it goes largely unlistened to. They don't want to hear it because they don't like the feeling of what it feels like to know that they are the problem. They want to hear someone say, here's the solution, and you can be a fuck up and still do well. Not in trading, you can't. Not here, you can't. Not here. That shit might float when you're in college and when you're in high school and grade school, and you can get away with some dumb shit. Here, oh, hell no. You will be punished. You will pay. And you may not be able to afford what you have to pay. And you may not have the wherewithal to stick it out. But you have to have a sober mindset going in. And you have to be honest. If you're seeing the things in the price action, that means they really do exist. Just because you start noticing them doesn't mean that that should be the same level of understanding so that way you go out and trade off of it next. There's a growth period there, and it's going to be different for all of you. And when I sit down, and yesterday was a perfect example, there are days when the market is literally just going to take off and start running. That's not a trend market. That's just a market that's going to be a very low resistance liquidity run. We don't have that right now, folks. Why? How do we know when there is going to be a harder degree of free running price, higher and lower, before we even start trading? How can we anticipate conditions where there's going to be high resistance liquidity? Because high resistance liquidity runs are very hard to trade in. You can make money in them, but you're going to get stopped out a lot. You're going to be frustrated with the length of time it takes before your trade overcomes the spreads and moves in your favor. And even when it does move in your favor, it'll move a little bit and then deep retracements. Move a little bit more, then deep retracements. They're not fun. It takes a lot of mental capital to hold in those types of trades. And I have done all the work that I've spent in the last 30 years on how to eliminate trading those environments and focusing on when the low resistance liquidity runs are going to be in play. What do they look like? That's an economic calendar for the week that has maybe one or two high or medium impact news drivers. Not what we had this week. The analogy I used when I was teaching paid mentorship and the analogy I used when I started this week on Monday with y'all. It's a landmine field. It will not be easy for price to go one direction and be sustained. You're going to get banged around a lot. But eventually, when the higher impact news drivers are done, whatever's left in its wake, whether it be inefficiency or liquidity that hasn't been engaged yet, then the market will be free to run rather quickly and easily. And that's where you want to be focusing on trading. That's the reason why I talk to you about all these things, because there is a greater appreciation for when you use the concepts I'm teaching in a climate and setting that you can know in advance is more likely to be in your favor than that of what we see now. I literally looked at a live streamer still trading his funded account shit with 15 contracts in slop. And you can read their face and they're just like they're stressing. They're stressing over it. I don't teach my students to trade like that. None of my lectures teach you to trade like that. I'm teaching you how to identify these hard times, still study in them, and that way, because you are seeing it when it's trapped in this consolidation and it's not allowed to freely run with a low resistance liquidity run. And what is a low resistance liquidity run? Because you're probably new and you probably never heard that expression before. When you can see a clear entry, maybe going long or going short, and your entry is so one-sided that it's so obvious, it's absolutely obvious that it's going to go higher or lower at that given time. And you anticipate it in advance, and there's an obvious inefficiency or relative equal high or low that it's going to aim for. It's just, it goes without any second guessing. It's so overwhelmingly obvious, and you cannot describe how you could go the opposite direction and trade it. That is the very moment that I teach my students to wait for. And the ones that don't wait for that, they know what it looks like, they know what it is, but the ones that say, I can't stand the wait for that, I have to do something else right now, they are the ones that send me emails. They're the ones that make videos and they talk to me in YouTube in private links and say, this is what I've done to myself. And they're crying. And I want to reach into the video and grab them by the lapels and shake them and say, why don't you fucking listen? You know how to do these things, but you don't want to listen. You want to find out through pain. You want to get the same scar tissue, like we're all the band, the Brotherhood. And here's my scar. Here's mine, ICT. No, here, look, I got a bigger one. Look at this. I lost my whole ass. Look at this. You don't want to be a part of that club. You want to be able to go. That's the whole reason why I teach the way I teach. I want you to go through this process so that way you don't suffer. You don't have to have all this drama in your learning. You don't need to have all that. It's completely avoidable. But human nature being what it is, you're going to trade with 15 contracts. You're going to trade without stop loss. You're going to overtrade, and you're going to think that you know better. Well, you will know better after you wreck your account and you lost your money. You'll know better that that was a dumb decision or decisions that led to the outcome. And then you'll hear my voice in the back of your head, and then you'll hate me because you'll hear me saying the very fucking things that you just did. I said, don't do those things because this is what's going to happen. And now you're stuck in that quagmire of, now what do? Do I email this guy and say I didn't listen? Is he going to help me, or is he going to tear my ass up? And usually I'll say, this is why I teach this way. So that way you won't be sending me this email. That way you won't be the person sending me a video link that takes me to a YouTube channel where I see your face and listen to you talk. And I get to see the emotions because you didn't listen. You tried to do it your own way. And that's what you get with these 20-year-olds taking my concepts, my buzzwords, and they're reinventing things. They're saying things I've never said and marketing that. And that's harmful to the audience because you're not teaching them anything that I taught. You're just using the image, the brand name as a draw to get people to come to you. And the purists, the ones that just simply do what I taught, and they're not out there trying to be drama marketing. They're not out there trying to war against everybody else or stand against the machine and say, I'm the new chosen one. They're the ones that are just constantly making money, and they're doing fine. They're having losses like anybody else would reasonably expect to have, but they're killing it. And they're not out there showing it to you. Look at what I did. Because they don't need that attaboy, attagirl pat on the back. They don't need that. Their bottom line does that for them. So that was my part of the psychological stuff and also correcting the asshats in my comment section. But this daily fair value gap right in here, this fib, remember this was the weekly fair value gap. Let me drop up into a weekly chart. You'll see what I'm referring to. That's this candle's high. See that? And that's this candle's low. And we drew that for consequent encroachment purposes. So that was that low right there. So when we go back into a daily, that's that low, and that's why it's hitting that. And we mentioned how the bodies were staying inside that daily fair value gap. So in case you missed it, I like to look for those types of things on a higher time frame chart. So whatever chart I'm trading on, or whatever chart I'm basing my bias on. In this case, since I'm looking for weekly and daily bias, it goes without saying that I'd obviously refer to a weekly chart and a daily chart. But for a session bias, like say you want to be trading just the morning session, And that's your business operating hours, where you don't care what the market does in the afternoon. You don't care what it does in London. You don't care what it does in Asia. These are the times that you can trade, and I only care about this. And what do I do? How do I formulate a bias for that session? It may be in agreement with the daily bias. It may be against the weekly bias. It's just very, very short term. How do you arrive at that? You use the 4 hour and you use the hourly chart. That's your time frames to determine the session bias. I don't care if it's London. I don't care if it's Asia. I don't care if it's New York. I don't care if it's the lunch uh, hour. You're using what the 4 hour is offering in terms of where's the next inefficiency it may be drawing to, where did it come from, where is it at right now, and what's it likely reaching for. It's only going to go up for buy stops, or it's going to go up into an inefficiency, a fair value gap, a city of some sort. And the opposite is said for when it's bearish. On the 4 hour and 1 hour, you're going to use that to frame out your session bias. Whether it's, like I said, the New York, the lunch hour, the PM session, the London session, or the Asian session. 4 hour and 1 hour. The same thing you watched me do this week with the weekly and the daily, that's what you're doing with the 4 hour. And that's going to give you the bias for the session. Sessions are several hours long. And if you reduce it down to the very specific trading times, the operating hours or kill zones that I teach you, the setups will usually form. The highest degree of formation is going to be in those set times. That's all your focus is limited to that. And you don't look at anything else. You don't look at any other market. You don't look at any other time frames. That gives you your bias for the session. And when you do it wrong, and you will, you take the loss and you stop for the day. You don't go back in. That's a real hard thing to do. But that's something that everybody, when they're learning how to trade, they need to learn how to take a loss. They need to limit it and not let it be too large. But also learning to go home and sleeping with a losing trade in your record of trades, in your ledger. You go home with a losing trade, a net loss day. And you need to feel what it feels like to come back the next day, follow your model, and not have any influence placed on your next trade because of the previous day's losing trade. And you're trying to avoid that, when I'm telling you that's a strength. That's a thing that you're going to need to tap into, because eventually you're going to have a losing trade. Nobody has a perfect record. Nobody has that. And to even start your career as a student and trying to trade and learning how to trade or read price action, assuming that you're going to be somehow capable of avoiding that moment, you might as well just get it out of the way. Literally just get out of the way. Flip a coin. Heads you're going to buy, tails you're going to sell. Risk 0.5% and just put it in. Whatever happens, happens. If it's a losing trade, done. You can't feel bad about it because you opened it up for that to happen. Now you broke the ice. Now you have to fix that drawdown. Now you have a real reason to be diligent about the next trade you're going to take. And if you win, well, good. Now you have an exercise in saying, well, that wasn't skill. So I can't place too much emphasis on that. Remember, this is a tug of war psychologically and emotionally, more so than it is an intellectual challenge. But everybody wants to elevate it to intellectual challenge and completely ignore the idea of how much of a emotional and psychological roller coaster it is. And they mask their insecurities by pretending to be high IQ assholes on the internet. And then show in perfect form that they're victims of psychological and emotional effects of trading, and the public looking at them and their results. So there's a rhyme and reason why you're learning the way that I teach and maybe kicking and screaming saying, I wish you would do it differently. When, if you feel that way, you're probably being shown the very things I'm talking about. You're trying to hide that from yourself. No one wants to hear about character flaws that they have. Nobody wants to go to a counselor or someone that has more wisdom and sit down and have them tell them everything wrong with them, especially in today's culture. It's offensive to them. Oh, you're racist. Oh, you're uh, you're a supremacist, regardless of what color your skin is. You're an elitist. You're something. You're trying to be something that is above everyone else. No, if you come to someone that you have respect for initially and you ask them to help you, and they observe the things that you're doing that are problematic, why wouldn't you want to take their counsel and their wisdom to heart? I would. I would have loved to have someone show me what I was doing wrong to myself and all the things that I was doing wrong in my trading. And I was pushing emotional and psychological needs in my life that I didn't get answers to. And I was placing them into trades and letting it be like a genie. The market was the lamp, and I'm rubbing the market to see if I can get the genie to come out in terms of profits and grant my wishes, which was to feel significant, feel needed, feel wanted and appreciated. And I wasn't trading for money. I wasn't trading to make money. I was trading to feel better about myself. I wanted to feel better about who I was as a person. And that's the wrong reason for you or me or anyone else to want to trade. Because if that's the reason why, listen, what I'm about to say, I mean this wholeheartedly. And if you've experienced this, it's going to resonate with you. When you go into the marketplace with external reasons why you're trying to take a trade or while you're trading at all, the pain of losing money is not going to be large enough for you to fear or respect it and use sound money management. You're willing to lose everything just for that one time to get it right. And that one time getting it right may not even be that much in terms of a win, but that win is the underlying reason why you're trying to do any of this. You have no idea how many times I wept over my journals because I was seeking something that the market was never going to give me. And I kept diving into it, wanting it to do that very thing. And the money was just in the way. Even when it was profits, it was still in the way because it wasn't still giving me what I wanted. I could make lots of money. And that profitable trading never satisfied me. It never gave me what I was looking for. And when I lost, even losing accounts, it did not hurt. Not enough. Not enough for me to take inventory and say, hey, look, I'm doing this wrong. I'm doing it for reasons outside of investing. I'm not doing it for trying to build wealth. I'm doing it because I need to feel better about myself. Because I was skirting on that very thin line of, do I want to be here anymore? And if I can get an answer to feeling worth it, am I worth it? You're placing yourself in an equation where the answer is never going to be satisfying. And that loop that you constantly put yourself through, that's what tears you down. And then you keep telling yourself, you don't deserve to be successful. That's why you're not successful. That you're a failure because you deserve to fail. You don't deserve to be successful. You don't deserve it. So you don't do the very things that the procedures and routines and processes that are given to you, you don't put them to work and trust that they will do the right things for you over time if you submit to them. Everybody has a bad day. Everybody has a relationship that outwardly everybody would say, wow, they have a wonderful marriage, they have a wonderful relationship. But they're not in there when you're having marital uh, disagreements, arguments, spats. That's the word I was looking for. Because you manage it. The outside world, you're not obligated to show the outside world through personal life. But everybody has these adversities. But I have found in me as Michael the person, when I was 20 years old, I needed to feel significant. And I think that that is something that plagues a lot of individuals and they wrestle with it. They don't want to admit it because they feel that that's a weakness. It's not a weakness. It's strength for you to be able to say, I have a character flaw that I'm having a real hard time overcoming. I want to be significant in my own eyes. Because everybody could say, wow, you're awesome, you're this, you're that. And on America Online, they were doing it, but it wouldn't fill it. It would not fill that void, that need I needed to have to feel significant, wanted, appreciated, worth. And that's what kept me losing my accounts. I would blow the account, work real hard, get second jobs, put the money in the account, and do the same thing over again, not understanding that what I was trying to do was impossible. It was impossible for me to try to get the outcome I was aiming for, doing what I was doing, breaking rules, not using stop losses, risking 10, 12% of my account, sometimes 20% of my account, because I wanted to win something. I wanted to slay a dragon. I wanted to conquer something, because in my mind, that would be, I'm formidable. I'm worth it. I earned that then. I didn't do it like everybody else. I did it my way. And my way, while I was ignorant of how the markets delivered price and how they behaved and booked, I was in that loop of constantly doing things all wrong and lying to myself, saying I'm going to eventually crack it by doing this dumb stuff. And you need to be reminded sometimes. And a lot of you don't want to hear it. But if you suffer from this type of thing and you wrestle with it, you got to put it down. You got to just relax and say, you know what? I'm going to do this the way it's being taught. And I'm going to submit to it. And the results I get will be honest. They'll be directly linked to the processes I'm following, and not me muddying the water by doing things that are outside the parameters, the scope of what the lectures and the lessons are, and what it is that you're doing it for. If you're not trading to make money, you're doing everything wrong, because there's no other reason to do this. And if you trade for the purposes of making money, that means your focus will be on not losing it. If it's about being a superstar on social media, you'll trade and have a trade on with no stop loss and lose $30,000 and delete the stream and pretend it didn't happen, but the whole world knows otherwise. All these things that people will do, things like that, they're wrestling with it too. But they'll deny it. They'll lie. They'll say they aren't. And they are. And they won't listen to good sound counsel saying from someone that's done it too, this is what you're suffering from. This is how you fix it. But they're going to continuously do what they want to do, thinking that it saves face in the public eye, and never grow better as a trader or educator or social media influencer or public figure or whatever it is they want to be. But trading should only be done because you want to make money. And when you trade with that in mind, you'll care about the money when it's the losing. You don't care about it when you're profiting. That sounds like it doesn't make any sense. Like, wait a minute. I'm supposed to not care about the money when I'm making it, but I'm supposed to care about the money when I'm losing it. Yes. Because if you're doing what you're supposed to be doing, you have the right sound logic behind it, the money making part of it will work itself out. You're always going to be able to look at it and say, I didn't earn enough in this trade because I got out too early. I didn't have enough on in terms of contracts or lot sizes if you're trading Forex. There's always a way to beat that end result in profit up. You'll always find a way to beat that up. But how many times have you ever said to your losing trade, I'm glad I only lost this much? You look at it like it was sleeping with your spouse. Like you caught it cheating with your spouse. You son of a bitch. Look what you did to me. You wrecked everything, homewrecker. And it takes you into a tailspin. You go out into a drinking, drug-using binge, and then you end your life. Metaphorically speaking, you blow your account as a trader. Go into a tailspin, start trading recklessly because of one small little loss, one paper cut, one reasonable transaction that, like insurance, nobody wants to use their car insurance or house insurance. But when you use it, you're glad you have it. Well, that's what your stop loss is there for. You pay it good money, but you want to pay it reasonably well, but not more than is necessary. and accept the fact that when you have it go to work for you, it's done its job. It's protected you from a larger loss. And all these things are central to being consistently profitable and well-rounded as a trader. And not enough is said about it. Not enough. Everything else is about how you make a lot of money, how you can afford to buy things that other people really don't give two shits about. So when I teach you, and what I've taught you this week, I'm wanting you to experience what it's like to be in hard market conditions. And you watched me explain to you that there's nothing to do yet. There's nothing to focus on beyond what we're looking at right now in NASDAQ. But that daily bias on NASDAQ, that may not pan out. Even after today and going into non-farm payroll, it may not even go up there. It may just keep on trading lower. Okay. Did I lose on a trade? No. In the public's eye, some of you may say, and I didn't see anybody in the comment section mention this, by the way, so I'm bringing it up in case you missed it. The daily bias that I was holding for Monday, Tuesday, and Wednesday, I wanted to see NASDAQ. I wanted to see if it could reach up into this fair value gap, touch the low or the lowest quadrant and maybe half of it. And then based on that, that'll tell me what I want to see going into non-farm payroll post FOMC. That's basically what I was looking at. But look how it traded yesterday. You'll hear me in the live stream yesterday describe how the two levels I was interested in, either one of them was going to be the catalyst for the other side to be tagged. That's not a breakout trader. That's me engaging sell side, expecting it to go up to buy side. That's not breakout. I'm not a breakout trader. That's somebody that doesn't know what they're doing. If it would have went to the buy side first, then I would have expected it to go for that specific sell side. That's exactly what I was describing yesterday. There's no ambiguous way of looking at it. That's exactly what I was explaining. That's what I wanted to see. But I preferred the initial sell side first. I wanted to see that. It didn't pan out that way. And it didn't even go to the buy side. It stopped. It just fell short of hitting it. And then we watched how multiple times it went up there intraday, making swing highs and just coming back down. And everything on the upside, every time it tried to rally, it was creating jaggedness. And that's smart money tossing short positions in all of that. Listen to what I'm saying when price is doing what it's doing yesterday. You'll have to listen to some stuff about the colleges. I make one comment about it and everybody lost their freaking mind. They're probably blue-haired. This skill set requires you to think in a way where who in the market right now is going to be targeted next? Who's the mark right now? Because if you don't know who the mark is, you're the mark. You're the victim that's going to be wrong or lose money next. So that's what I was teaching you yesterday live. Until it trades to the buy side or until it trades to the sell side, I do nothing until more information is given to me. When we are inside that silver bullet hour between 10 and 11, the fair value gap that I highlighted right in here, when it started showing an unwillingness, sub 1 minute, this is a 1 minute chart, but the bodies were telling us, hey, look, we're having a real hard time getting out of this to the upside. After we've seen a low taken here, rallied and failed, and then that low taken there. So now we have 2 times the market has shown its hand that it's going to go lower. We've had multiple times trying to trade up. I told you about the opening range. I said, Anytime I have a PD array, and I grabbed the ones by their nose that like to take things out of context. When I was doing Twitter Spaces, and I would call out individual 1-minute candles and say, note this candle here. That's not an entry. I was teaching you how to look at price and refer to these price points. That's all that was. Same thing happening in a live stream. But if I call on a specific PD array and it doesn't completely fill it in, if it's an inefficiency like a fair value gap, and it doesn't even go to its halfway point, consequent encroachment, that's telling you something. It's showing you its weakness or its underlying strength. And you want a market that's predisposed to go lower to show you a weakness. That's one of the strongest things you can see in terms of using my PD arrays. It measures the strength or validity of the next subsequent move. Much like I taught when I say, if the market's going to go down, I like to see it take out buy stops first. Because if it does that and I'm bearish, then I know I have a big move coming. Because they have unseated someone and took that position over at a higher price. There's only one reason to do that. Their greed. They need to be placed in a higher price at a premium, and then they're going to let the market move lower, and they'll distribute in a discount below some old low or old lows or inside of an inefficiency that's in discount. But I mentioned with the opening range, and I'll draw that here because I do have regular trading hours on the chart right now. This is what we were looking at, where we closed or settled previous session and where we opened. See that? That little mark right here, that's equivalent to what would be the Fibonacci halfway, consequent encroachment. Look what's happening here. It digs above it, reaches real high, body staying within the range of the first pass higher. Even though we wicked higher, that's not higher high, higher low, I'm going to keep going higher. Go back and watch your favorite live streams. They were looking for higher. We were sitting still, waiting. I expected to see it trade to the halfway point of that gap. That's this level right here. When it was down here, I said that the highest probable price when we have a gap lower is the reach up into the halfway point. And then we have to see how it trades there. What does that mean? Well, what I'm explaining to you here. The first pass here, look what the bodies are doing. Yeah, we closed above the consequent encroachment, then dropped down and rallied once more. We wicked above that high, but were the bodies giving you any confirmation that that was a higher high? Remember, the wicks do the damage. What was it doing? What type of damage is it doing? Knocking out anyone that went short here that had a stop loss just above it. Why don't we want the opening range to be filled entirely or close the gap, as the expression is, when we're bearish? Because if it can't fill the gap, that means we're really, really bearish. Then that means what? If we take out that low, listen to the commentary. If we take out that low, then we're likely to have a large range down day. Those are my words. That's what's in the commentary yesterday. But you're not listening for that. You're not taking notes. But it's there. I'm not editing anything. I didn't re-upload anything. I'm certainly not able to hide it. So when I'm talking about specific PD arrays or buy side and sell side, I'm not bracketing and strangling the market, or straddling the market rather, and waiting to be able to say, see, it hit that one, so therefore I'm right. No, when I do that, that was in the context of the commentary I was given at that given moment. We were looking for higher prices on dollar. We were not looking for lower prices on dollar. It went to its buy side. It moved higher after hitting its daily fair value gap high. And then Euro and cable fell out of bed. NASDAQ traded below its relative equal lows. That's That's the one I said. When it did that, I said, I'm done. I would be done for the day. I would turn my charts off and go do something else. Why? Because of the nature of the calendar. And then when this wild return all the way back up to what level? Where did it go back to? Where are the bodies at? Consequent encroachment of the opening range gap. The gap didn't get filled. This is the remaining portion of that gap. Left it open. That's exactly what you want to see. You don't want to see bullish order blocks trade below its mean threshold or halfway point. You don't want to see that. You want to see the upper half. That is the secret to it. Fair value gaps, you do not want to see a inefficiency closed in entirely. You don't want that. You don't. Why? Because it's telling you it's got someplace to be, and it ain't worried about nickel and diamond, the price ranges that are left open. That's the signature that smart money looks for. That's what they're looking for. They're looking for that. They're not looking for pennant patterns. They're not looking for harmonic patterns. They're not looking for bullshit. They're looking for measurements with their charts that tell them, this is telling me we're done. I'm waiting for price to get into this range of inefficiency or take out this high. You don't need a depth of market. You don't need a... It's probably good that I don't remember the company's name. There's lots of different applications and resources out there where they show you supposedly where large pools of orders are resting above and below certain price levels. You don't need that. In the beginning, it's useful to communicate the idea, but you'll see quickly that the highs and the lows are in your chart. Like, you can see them. They're not hiding. And I used to facetiously say on on Baby Pips, I can see your stop. And just by me saying that, I could gauge the level of maturity of the traders that were conversing with me when we had the chat room. And they're like, how do you know where my stop is? Like it's some mystical bullshit, right? But really what they're saying is I don't know how to read charts. I don't know how to read price action. And that is telling. That's very telling in an individual. Because if you don't know where the stops are, then you don't know where the market's going to go. Because that's where it's going to go. That's the lifeblood of the market. Liquidity. Without liquidity, there's no trading going on. None. Zero. Zip. There's got to be a buyer and a seller. So how can we know with great assurance where the buyers and sellers are going to be at? By studying what prices recently done, where is it at right now, and where is it likely reaching for? And if you have those three things understood, and there's some times when you're not going to know that. Yesterday, when we were in all this mess in here, I didn't know if we were going to run to the buy side, and I didn't know if we were going to go to the sell side first. I wanted to see sell side taken first, because then that would have given me the conviction to try to trade for the full closure of the gap. Why? Because it ran sell side, and the obvious would be completely close in the inefficiency, and then wait for FOMC to then roll over lower. That's what I would have said, but I'm telling you everything I would have done if it would have done that. Because it didn't happen. That's unfortunate, but I gave you when we were right here. All right, we're about to roll over because everything is indicating that we have done all the work up and failed. Look at the bodies, okay? Here's your body on that swing high. This wick, the bodies there are lower than that. You see that? Look at the bodies here. It's lower than those bodies. Those bodies here are lower than that. What's actually occurring there? Smart money is accumulating short positions. That's what that indicates. Find that in your fucking books. Find that rebranded from anybody. It's not out there. It is now. It'll be in every book on Amazon now. But that's what you're reading. You're waiting for that. And when you see these swing lows being taken out, relative equal lows, swing low taken, that right there tells you that we have now have a shift in market structure. Does that mean enter, go short right away? No. We're in a consolidation. You have to demand more information. So when you have a fair value gap, excuse me, when you have a gap and you're seeing the candlestick's bodies failing to get outside the other upper end of it after you had all this behind you in terms of backdrop, that's now giving you the capability to say, okay, the narrative is now in play. They've assumed they've assumed short positions by knocking out long holders and stopping out anyone that was already short. Inefficiencies, that's where your real support and resistance is going to be. If you want to think of it like that, you'll be able to discern where those real support and resistance levels are, not just where did it turn last time, because that doesn't work. That doesn't work. Does not work. Okay? Just like diagonal support and resistance trend lines don't work. They're too subjective. I promise you, billions of dollars are not being risked on this, the sake of the degree of a trend line. Like that's a religion. That's something that look, man, I ain't gonna beat it to death. But the bodies are telling you the story. The wicks do the damage. Yes, they're allowed to trade outside that inefficiency. But the bodies, go back and listen to when I'm talking to you at that time. I'm expecting it to now roll over. I talked about the volume imbalance. I talked about the other volume imbalance. And when it traded there, I said, now we want to see it aggressively run because it's going to be heavy now. It's going to attack where it's smooth. Where's the smooth levels at? It's these two relative equal lows. And then once it goes below here, then it should stay really heavy and quickly run for that sell side because they don't want to let them pull those orders. If they drop it slowly, anyone that had a long position that has a stop loss in here in the form of a sell stop, they'll get the picture and say, okay, this is probably going to be a losing trade. And that pool of liquidity will reduce in size. And if smart money has sold short up here, up here, up here, and up here, they won't have the liquidity to be counterparty to buy back from covering their short because it will evaporate because of the market just drifting lower. That's how you know when ICT says I'm expecting large ranges, it's because everything that's in play right now, all the damage is done and everybody's stuck on the wrong side. And the smart money is going to be looking to get out. So if they're short, they're going to be looking to take out a low or relative equal lows because there's going to be pending orders in the form of sell stops, which is the exact opposite side of a short position being covered when they buy at the market or at a limit order below these lows. And that's why we drifted below that. And I said at that moment, I would be done. That means I would have never suffered the drawdown or a return and retrace back into this area right here. But it's interesting how it went into that midpoint again, the consequent encroachment, and then fell out of bed again and attacked a larger pool of sell-side liquidity. So that's what you should have gleaned from yesterday. That's what was being said to you, but I had other things I was talking about at the same time, and maybe that causes you to lose focus, maybe a distraction, maybe it makes you angry, maybe you turn my live stream off and went to watch somebody else because they'll press a button on a demo account, and that's fine. But the recording's there, so now that you can go back and listen to it in context and see really what I said. Now we have a gap opening here, so the same thing applies as we did yesterday. Regular trading hours, this is our opening price and where we settled yesterday. So there's your opening range. And you can do this, or you can use a fib. You can put your fib on where we settled and where we opened. And you have your quadrant levels on it. Here's your consequent encroachment. That's always the high probability draw. Even if it's going to go lower, we always reasonably expect it to at least try to make an attempt to get to that middle point. Okay. That doesn't necessarily mean or invite you to take a trade. It's just all part of reading price action. We opened below that low here. Initial run, came back, touched the lower quadrant of the opening range. watch and see if it wants to take out this low. If it does and it comes back up, we'll watch to see if it wants to reach the midpoint of that opening range gap. On a day like today, after we had such a large move lower, think about what the retail traders are thinking. They now have the opportunity to do what? Go short, because they think it's time to go short. It can go lower today, but because we're at the opening bell, anyone that wants to use this as a breakout going lower, they could be net short now. Where are they going to place their stop loss? Right here. You're not trying to trade. You're trying to learn how to read price action and build narrative. So think about the individuals that were selling in this area of inefficiency. All these opportunities in here to be short, getting below this low here. What's resting below that low? Let me take this off. So individuals that were short up here, they're looking for an opportunity to cover with the liquidity that would be resting below that wick. We opened with a gap lower quadrant traded to, now taking out the initial low of the day. So now we're seeing two areas of sell side liquidity taken after a large range down day. Every time this occurs, I'm considering how the traders that are potentially trying to be short on the new day opening where we're at right now, the opening bell, how do they feel? Move this over a little bit. Every time we make a lower low, and is it met with a lot more momentum on the downside, or is it trying to give and take back and forth, back and forth? So we have liquidity here. They've engaged that. They took out the initial low of the day 2 times here. So we had 1, 2, 3 passes below this low and below the initial low of the day. Now, initial low of the day on the 30-second chart isn't all that terribly important, but I'm watching price on all the time frames that I observe. So I have a matrix of charts where it's the 1 minute chart, 2 minute, 3 minute, 4 minute, 5, and then I have a group of the 5-second, 15-second, and 30-second charts. So I'm looking at how all of those time frames are providing me the details. Said in another way is I like to see it when it does these types of things. Each time it breaks lower, it's trapping short holders or new shorts in the marketplace after a big down day. So in my mind, I'm expecting them to try to get back up to that midpoint of that gap after getting people stuck down here short. And they may get overzealous and want to come back all the way up to the upper quadrant. Imagine all the individuals that held short from yesterday. They have a wonderful opportunity to be covering down here at a really, really low price when the public is trying to do what? Be a buyer. I'm sorry, be a seller. They want to sell short because it seems obvious now. There was a big down day yesterday, so they're always coming to the party late. So street money's coming in. They're trying to be short at a time when smart money has already made bank but hasn't realized that gain yet. So how are they going to do that? They're going to be buying sell side liquidity. So they wait and they allow the market to offer new lows, but are these lows being met with a careening price breaking hard lower? Not as of yet. And that's what I'm referring to. I'm looking at that and studying that and submitting to you that this level here, which is mid gap, consequent encroachment, and upper quadrant is reasonable. And that's also real close to that up close candle here. So there's a couple things factored there. I wanted to give you guys a 5-minute intermission at 9:20, but I lost track of time. Sorry. I'm going to take the shaded area away. We'll leave the fib levels up here, but you'll know that that's what this is. It's the low of the opening range. That's where we opened up for today, first trading price. And then we have the lowest quadrant, mid gap. This is always the highest probable retest. Doesn't mean it will hit it. If it goes up and starts to break lower, then that means we are really bearish, and who knows how low we'll go. Everything's measuring strength and weakness, and if we can't reach the midpoint, which is that's the parameter, just like mean threshold is for an order block, just like consequent encroachment is for a fair value gap. That is your decision making level. Okay, it helps you measure, should you be really buying in that run? And said it another way, like say you don't have the experience or confidence to buy when the market's dropping down into a fair value gap. Like you're still learning this. You can wait for that to happen on a higher time frame. And then if it supports price at the midpoint, or it doesn't go to the midpoint and starts rallying like you would like to see if you were bullish, then you can drop down into a lower time frame than that time frame. And the very first fair value gap you see traded into, enter on an institutional order flow entry drill. That means the lowest low of the candle that makes the high, the fair value gap that forms on the smaller time frame. Your limit order to 5 would be there, because your expectation is an institutional order flow entry drill is a time where the market will go into a fair value gap but won't even trade to consequent encroachment. So now you're using the higher time frame fair value gap that supported the idea that you wanted to see directionally, and it gave you the signature and price action that it's not willing to hit its consequent encroachment but rallied sharply higher when you're bullish. Drop down to a lower time frame. So if you saw that form like on a 5-minute chart, and you looked at the first fair value gap that formed after that 5-minute chart's fair value gap formed and showed its willingness to go higher, buying the first institutional order flow entry drill, that's how you enter on that, and it's not chasing price. And you'll use the same stop loss mechanism, but using it on the institutional order flow entry drill time frame of the smaller time frame. So your risk is small. You're not chasing price. You're trading within the price delivery continuum. Everything is moving in sync, and all those signatures would be basically confirming what you'd be hoping to see in price. We don't have anything yet, so right now it's just banging around. Those are a little too smooth. I don't have all this stuff on my chart. I'm only putting the things on there that I'm paying attention to, that's salient to me while I'm watching price with you. All right, that's going to be in my way. So we have NASDAQ 30-second up here, 1 minute down here, and a 15-minute chart over here. So if we can rally, there's no, in a 15-minute time frame, there's really no inefficiency until we get to that area right there. See that volume imbalance right there? Let me zoom in for it. Right. That right there. That's a little tiny little crack. Little tiny little kink. That's a weak link. If this price action, all this price action right here, all that move lower, if that was a chain link or a link, a metal chain that's linked together with metal links, the kinked weakest link is right there. So my mind is if we can go in here and try to do like a 3/4 or full closure of the gap, we have that also. So that low of the volume imbalance right there, look how it overlaps with the closure of the gap. And that's using a 15-minute time frame. So now we don't need to be on the 15-minute time frame. We can drop into a 5. What's up here? Relative equal highs. What does that mean? There's buy side resting above that. And that's real close proximity to the midpoint of the opening range gap. So with those levels in mind, I can go back to watching my really, really small time frame. And all the points are in the chart, so you can see how they're converging around one another. I'm going to take this off because we don't need it anymore. And now the sell side is here. You see the reaction I was mentioning when we were trading below these? I said it's a little too smooth in there. They dipped below it and then went above for any short-term buy side there. There's our gap here. Let's watch and see how that behaves. Buy side is resting right above this candlestick's high. My wife's giving me the evil eye. She didn't want me to do this in our morning room. Our morning room's right next to our kitchen. And she's over there looking at me, giving me the evil eye, washing her hands. You better realize who butters your bread, woman. Ladies, please don't email me. I love my wife. Don't get it wrong. I'm just being funny. Now, originally, my students know that we don't try to trade the morning of FOMC, but it is a perfect environment to study. If you're going to trade FOMC days, you have to wait until at least 2:30. That means the first initial run on FOMC, that's usually what we're waiting for. That's usually the bad, unexpected, you don't know what they're going to do right away. And then after that, you can see what the lay of the land is, where the liquidity is that they haven't engaged, where the inefficiencies are. And then you can trade appropriately there. Doesn't mean you're going to be right, but that's the usual protocol. Fading the initial move. Probably till noon. Maybe not till noon. He's over there whispering, trying to get me to get up and move out of here and go up into my office or go downstairs in the basement. No, I'm being stubborn. All right, so we have relative equal highs in play here. Went a little bit beyond the scope of my personal taste for that little area in here. So I would like, in this case, I would like to see it do this. I'd like to see it support price and springboard off of that and then reach for the buy side. You're going to get me laughing, and once I start cackling, I won't be able to focus. Stop. So what's important to note in here is that we had this one single wick. You see that? Or tail. So in and of itself, that right there is very thin delivered price action. And this is being shown to you on a 30-second chart. So in and of itself, that right there shows a deficiency for price. It need not be considered immediately today, but inside that range, and this is going to be busy for a moment while I'm putting this on here, but I'm trying to communicate something to you. So because this wick, let me draw it over here so you can see, this wick or tail on the candlestick, that's all one single pass on a 30-second chart. So did price allow enough time for traders to buy and sell in that range between where we close on that candle and the low? One would, if they were being reasonable, no, it didn't. It didn't afford traders enough time to participate there, even though it did deliver it quickly. Then we had this wick that dipped into a little bit, and then they had this wick. So this gets changed to this. So this portion of the range is still a little bit too thin, where we've had multiple passes between these three candles from that low to that opening. You understand? You may not understand, but watch the video again a few times and you'll see what I'm talking about. The exposed area is this low to that low. Now, what's resting inside here? We went up into that range and we left this portion of that inefficiency there. So we have relative equal highs here and here, and the markets dropped down, opened lower. It had gap opening, and we left relative equal what? Highs. So in and of itself, by itself, that's enough for me. But then we have the opening range gap, that gap lower. So that means we have a lot of opportunity to want to see it travel up into this area here. In my opinion, the most interesting price point is that mid gap, which is right in here. And it would do enough to clear up the buy side if it wants to go lower, or if it wants to sweep this low one more time, then reject and start running aggressively for a mid gap, then attack the buy side. And why do they want to do that? They could buy the sell side and then distribute to the buy side. So buy sell stops, sell to buy stops. You shouldn't crack your knuckles, ICT. See these lows right here? Real smooth, right? You dip down into it. I'd like to see it spring. It has yet to come up out of that for inversion. Coming above it and then come back down into it. That's what I'd like to see. Then run into here, and then mid gap, and then see if we can get up here and do a 3/4 close on its opening gap. That's a sweep so far. It hasn't done anything on a closing basis. It's got to close above it and then come down and touch it. And again, this is a 30-second chart, so it's a lot of movement in between the high and low of each individual candlestick. But it's moving the same speed on all time frames. But the rate of change between candlesticks, highs and lows, is much more higher paced. And that it gives you see the fair value gap we're in right here. See if there's any sensitivity there. It's too much of a closure for my liking. Doesn't mean it can't still support it, but ideally it would have been like right here and then sent it higher. We have the low today, smooth lows taken out. We're inside of a fair value gap. The body closed inside of it. We wicked outside of it into a volume imbalance and didn't take out that low. But I want to see, does it have any interest in getting up into at least half of its gap? Because these are all points of consideration for how we trade going into the lunch hour, which is obvious precursor to what they'll do in terms of damage for the afternoon FOMC circus act. Now, whenever price has this type of action here, where we have a fair value gap, we're looking for something to support price, maybe moving higher. You want to extend those in the future, not just they're closed and now it's done. Okay, that's not how we look at inefficiencies in price. If it's good, it'll still be good in the future. And the same idea we use when we look at them initially is, does it have a willingness to respect the upper half of it? If it doesn't, it's indicating that it's probably suspect and don't do anything yet. Demand something else in addition to that. Looks like they want to sweep that low. They left relative equal highs here. Now where we're at is nothing. I can't do anything where we're at right here. But what I would like to see is the market want to get above this. To make it plain, I don't want to sell short after a big day like this, like we just had yesterday. And after we have a large range day, I teach my students that the morning session should be avoided, even if this was FOMC. Like say it wasn't FOMC, say it was a normal, regular non-event on the calendar. We would still avoid trading the morning session. We would watch it, get intel on it, so that way we can use it in the afternoon. But the trade would be the afternoon session. Large range days in the morning session, you get this type of action here. Usually indecisive. Sometimes it can just bang around. It can go seek and destroy, where it takes the low out, takes the initial high out, then takes the lower low that was just made, and then comes back and makes a higher high and keeps hanging around in the middle of the range that's created. And then during the lunch hour, it clears it up and then the PM session is the better trading condition. But with all that said, I'd like to see it sweep the low, come up, use this gap here as a stepping stone, then get above here, use that, only trade down to half of it, and then rally. And then the very first fair value gap after that, I would indicate and hopefully get a ride into this level here. So there's a lot of things I would demand for it to be in price before I would take action on it because of all the factors that this gave you. I'm comfortable if it was to run away and drop another 300 handles, it's fine. It doesn't fit what I'm trying to do or what I would expect to see in price. And it gets back to making money with something you didn't really understand why it did it. That's not skill. That's just the lottery. Okay, and people win the lottery. And usually when they win the lottery, they lose that money once they get it in their hands, spending it stupidly. Just taking a peek at the other indices. I'm actually talking with you only using one screen. I'm using a laptop, obviously, because I'm not in my trading room. So I'm trying to I'm trying to do it in a manner where it's closest to what you'd be likely to do, not having all these monitors I have at my disposal. And dollar index. Let me get a peek at what she's doing here. Now, think about what I was describing to you yesterday when we were looking at the NQ. It kept reaching higher, making swing highs, but failing to show any kind of continuation, and the bodies were reflecting that as well. So it was building smart money short positions. They left all the sell side untouched until later in the day when obviously when we were closing the stream, it had already went down and took the target out for the sell side. Here, look what we've done. We have taken this low out here. These lows have been swept. We've done all the damage where? Taking out sell stops. So what is it leaving? What's left untouched right now? The buy side and any portion of the gap above that lower quadrant. The lower quadrant is this level here. That's the opening range gap low. Got a little bit animated there. Got some news event coming out. Came back up into consequent encroachment of that gap we were looking at. Still nothing I would trade on. So again, even with this spike up, they didn't engage the buy stops that are resting right above these smooth highs here. They ran aggressively to take out anyone that would be long, and now new shorts are caught in as a breakout. So focus here and here. Again, the same thing. We want to see it trade above and use these as footholds. Let's see if we can get up to mid gap, which is here, and 3/4 of the gap. No anxiety, no I'm going to miss a move, no FOMO, no nervousness. We're just simply waiting and seeing if it's giving us any inclination that it wants to behave a specific way. Fair value gap, fair value gap. What did I teach you yesterday? You'll have to look at the Euro discussion towards the end of the live stream to get what I'm referring to there. That's your homework. Imagine this is your first day trading. How confident would you feel with all this? And for the folks that have not been paying close attention because you're doing other things, I'm only interested if the price can get above here and here, and it acts as support. I'm not interested in being short. I'm not interested in chasing it after yesterday's run lower. Absolutely not. I'm not interested in that. So, but what happens if it drops? Then it drops without me. I don't lose my mind over that. I don't get mad about it because it doesn't fit what I'm trying to do or what I'm comfortable. Let's say it that way. I'm uncomfortable taking a trade short after such a large move ahead of FOMC. That's probably the better way of saying it. I am comfortable if price were to do these things here because I know if it's going to go that high and respect these PD arrays, then this buy side is likely and mid gap is certainly likely, and then maybe as much as 3/4 to a full closure of the gap. Because I'm operating under the pretense that it is street money trying to get short still. Now, sometimes street money gets it right. There's always some kind of a, you know, they call it the stars lining up, right? the I don't have a whole lot of faith in that kind of stuff, but sometimes retail traders can get it right. I am not willing to do that here. And I will err on the side of caution and say I'm more comfortable trading with the idea that retail is trying to be short this morning. So I don't want to see their perspective. I want to see how they could be victimized and see the market go against that school of thought today. The trick is, and this is the difficulty in it, is knowing how many times they're going to want to take the short-term low out, but not really travel far before they rip it the other direction. And even when it does, if it does pan out this morning, they may just take it in one single pass all the way up to mid gap and offer no fair value gap or no stepping stool to get into a trade. And that sometimes happens as well. And you can't get mad about it because you don't have control over price. You're not going to tell price what you want it to do, and it's going to listen. I mean, you're not ICT after all. Good grief. Sorry, I just set myself up for that. I'm not realizing it. I couldn't waste it. I'm going to place you on mute just for a quick moment. I'm going to grab something from the kitchen that may make noise, and I don't want that to be in there. Bear with me 1 second. Okay. Had to run and grab some socks. My feet are freezing underneath the ceiling fan. We keep it kind of cold in the house. But with the ceiling fan blowing on me too, it's a little too much. All right. Another lower low here.